Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're going to talk to Scott Hildenbrand. I asked Scott to join us on the podcast today. We set this up a couple of months ago. The goal was the election would have been come and gone by now, which it has, and just wanted to figure out if the election will have any effect on Scott's world. These days, liquidity is such an important portion of running everybody's bank and credit union that I thought might make some sense to just see if the election results has anything to do with how you look forward. So, okay, welcome back, Scott. Thank you for joining me again.
Thanks, Charlie. Thanks for having me. As always, I enjoy it. A lot of fun.
I think the last time we talked about this, the last time we had you on the podcast, we were having a conversation around unrealized losses, for lack of a better term. They were a big deal as interest rates were rising. People were kind of getting stuck with investments that had been long-term investments, for lack of a better term. Has that gotten any better, worse? Like, are people selling them off? Like, what's that look like in that space?
Yeah. It's a really good and timely question. So to answer the math side of it first, Charlie, and just for the audience to remember, most of the banks in the country own assets that were either originated or purchased about 3 or 4 years ago when rates were at all-time lows. Right. So to level set everything. Yep. And then you fast forward to where we are today, we've started to see, we obviously went through the SVB crisis, which was combined with the 500 plus basis point move on the short end of the curve to attack inflation. Next thing we know, we had all these unrealized losses. So where we are today, kind of fourth quarter of 2024, it's really interesting. So time is your friend when you own assets that are under the market. So it's gotten a little bit better from that perspective. But what's more your friend is the movement in interest rates. And for a while, I would say up until about October 1st, so September 30, October 1st, the interest rates on where these bonds would be priced actually had come down a fair amount. Then October 3rd, I think the right date, we got the first 50 basis point rate cut. And ironically, about 12 hours after that was digested, all we've seen since is the belly of the curve go higher. So that's interesting. Yes. So now bond losses have gotten worse from September 30th to when we're recording today, November 14th. It's actually gotten worse from that point. Yes. Now they were better leading up to October 1st or so, but the last, call it 6 weeks, has been a tough stretch. And what's interesting is a lot of banks now, and you're reading about some of them doing this, a lot of banks now are doing what I like to call reacquiring themselves. And they're selling a lot of these below market assets at losses. So when we say loss, we don't mean that because I own this asset, I'm not going to get my principal, the dollars I invested back. I'm actually going to. What the market is telling us with these unrealized losses is that there's a huge opportunity loss. I could be with the same risk earning 200-300 basis points more, yet I'm stuck earning a sub below market level yielding asset. So what a lot of banks have said is, I've already owned this loss. I'm bleeding this loss every quarter through my margin. Should I just, in fact, rip the Band-Aid off, sell these assets today, take all the proceeds back, and go invest in a higher market today where you can get, let's call it 5% comfortably with almost no credit risk, and just acknowledge the fact that I'm going to rip the Band-Aid off, and instead of bleeding this loss for the next 4 to 5 years, I'm going to rip it off and get ready for 2025. So a lot of banks are reacquiring themselves, preparing their balance sheets to get themselves into a better place for 25, because a lot of folks were underwater because our assets reset in 20 and 21, and our liabilities all reset in 23 and 24. It doesn't take a rocket science to see that the assets are low, the liabilities are high, nobody makes any money. That's why bank margins have been struggling for a while, and we're just starting to see them come out a little bit better. But that's what people are doing. When you hear about loss trades or bond portfolio repositionings or any other term you may hear, that's where people are spending their time. I'm spending a lot of time helping banks think through that.
So if you're a bank and you have to take a loss and you're publicly held, that shows against the earnings, right? I mean, well, I know it shows against the earnings. Let me rephrase that. that you would probably have a note saying this was part of why our earnings weren't where they're supposed to be.
That's exactly right.
You'd have a couple of line items that would say whatever there. Whatever.
What you would really say is it's a one-time item that below the line mark, I sold a ton of assets that were not in our normal run of business. Our normal run of business is we take in a deposit, we make a loan, and we manage that spread, right? The other course of business for liquidity is I own these securities. I sold a bunch of those at a loss, which will be recognized this quarter in a loss in my earnings stream. So my net income is lower, and I'll highlight it that way. What's interesting is that investors in these publicly traded banks are not surprised, they're not shocked, and for the most part, they're not upset because they've already seen it. Opportunity losses are actually held in your GAAP capital. Okay. So investors don't like surprises. This is not a surprise. This is something they've seen since 2022 when interest rates started to go higher. They said, oh, these banks have some unrealized losses. So it's already built into their future earnings projections. Everybody knows about it. So it's not like I sold a loan because of credit problems. That scares and spooks the market. This is more of I'm repositioning an asset that I owned from 3 years ago. The world's changed. My balance sheet has changed. My strategy needs to change. And I'm going to rip the Band-Aid off and do it now.
Okay. You said the loss is a loss of opportunity, not a loss. Mm-hmm. Okay. So
that's right.
I always thought of a bond as this. If you buy it at par and then you have a coupon, right? And I'm sure this is old school, but this is the way, they taught you in business school, whatever.
Yep. Yeah.
The coupon pays whatever the percentage is. And so you take, you've paid X and you get, either the basis back plus the coupon, something along those lines. So if I bought at par and I've been taking in these income streams throughout, and I sell below par.
Yep.
How's that not a loss? That's where my head's can't.
No. The loss is the loss, Charlie. You're exactly right on the math. Here's the one part that I want to make sure is clear. If you didn't sell that, right? So you bought it at par. Let's say you bought a $100 bond and it's at par, and you're earning 2.5% in a 5% world.
Yep.
Right, for the next 2 years. That means you're basically going to get 95 cents back today, but you get to invest the 95 cents at 5%. And that's the opportunity. Does that make sense?
Yeah, absolutely. When you talk about, so they'll sell it at a loss, and that's the loss that shows up on the books. They have to say, this is $1 million asset. Now I'm going to sell it for $970,000, something like that.
That's right.
So that's the correction. And then going forward, they get to take $970, reinvested at the 5%, lower risk, and okay, understood.
And again, to be clear too, that 2.5% coupon in a 5% world, if I hold on to it, I'd argue I'm still taking an opportunity loss as well, right? Because in my margin, I'm earning 2.5%. When I look at the market, is earning 5%. So it doesn't show up, to your point, as a loss in the earnings stream, but it's a reduction in earnings every single quarter, which is really mathematically the same thing.
Yeah, I got you. So when you do look for, which is what most investors are interested in.
That's right. You buy the future. Yeah.
Let's get the publicly held out of that sentence.
Okay.
And let's go to families, right? Because families think of the income stream a little differently. If it's a family-owned, smaller operation or closely held, like that.
Yeah, closely held. Sure. Mm-hmm.
Okay. So what's the conversation there? Because I would think that the conversation would be, I don't know that I want to clean out all these assets at once because of that one-time hit, right? If I'm an investor, going back to the side of the equation, which told you we weren't talking about, but like investors will sit down and go, okay, I get it. How much of it do you want to take as a one-time hit, right? Families think about that somewhere differently or closely held. They, because they're sitting there waiting for their dividend or something along those lines.
Yeah. And again, even for publicly traded dividends, you can only pay out a certain amount of dividends. I can't take too big of a loss ever that would disrupt the ability to pay dividends. But your point is a really good one. When let's use a privately held, family-owned bank, you get the benefit of really looking at things long-term. I think a publicly traded bank looks at things short-term and long-term. I think a privately held can just say, look, this is what we want to do. But I think, Charlie, the way I work with a private company like that is I say the math is the math. Let's lay down the opportunity here. If we sell this, and yes, our net income goes from Y to Z. However, next year's earnings and the next year's are great. But the more important part of all this is that I always tell whether you're public, whether you're private, it doesn't matter. If you're taking a loss and you tell me you improve earnings, you better have also the word A-N-D, and what else did you accomplish? And what I mean by that is for a lot of banks, they need to reposition their balance sheet for the next movement in interest rates, for a steeper yield curve. And so this is the opportunity to rip the Band-Aid off, go get market level assets at 5%, but most importantly, reposition my balance sheet from an asset liability interest rate risk perspective to perform better in the future for potential next movement in interest rates, shape of yield curve, all of that. And so this is why I say you're reacquiring yourself and you're really digging in and looking hard. And again, it's a different conversation with private versus public, but at the end of the day, the math is the math, right? And I'm either going to earn 2.5% for 4 more years, or I can earn 5% next week, and I rip the Band-Aid off. Which one is better? My future earnings are better. My current earnings are worse. Well, what am I getting for hurting my current earnings? That is an opportunity to reposition the balance sheet to protect against the next movement in rates. And so I always tell everyone.
Is that different investment terms, different product?
Mm-hmm.
The argument might be, I made this mistake. I don't want to make it again, right?
Yep.
I want to figure out a way to even if I don't get a better return, I want to be able to get rid of some of the risk going forward, right?
Yes.
That's all got to be part of it, I would imagine, right?
Yep. And I don't mean to bore you with this comment. Not all duration is created equal. And so what I think a lot of banks are focusing on, if they're going to go down the restructuring route, is they want to make sure going forward that small movement in interest rates do not dramatically change the cash flow stream off of those portfolios. That's one of the big things that happens, right? Interest rates went from 0 to 5, so we had extremes. But what I would be really careful of is I don't want to sell optionality risk anymore. I can't handle it anymore. My balance sheets change too quickly. I want to get some known, predictable cash flows, regardless of movement in rates, on my balance sheet today while we're living in the high 4s, low 5s, so to reposition the balance sheet. So I think that's actually a really important point. And I think I'm glad you asked it, and I'm glad we went off script on that. It's important to think that through, that we're reducing risk when we're taking a loss. And people will probably chuckle at me when I say that, but I really believe it, because interest rates have moved and your balance sheet has changed so much in the last 4 years. You can't tell me the strategy you had in place 5 years ago is the right thing for you today. But if you sit and wait, you might miss this opportunity to go get higher yielding assets, but more important, better predictable cash flows that fit the future stream of the bank better.
Okay. All right. So if you are contemplating, right, a lot of merger acquisition stuff going on out there.
Yep, sure.
If you're and work in the contract space, so we're always looking at, if they're going to go sign a technology contract, they got to look 5 years out.
Yeah.
In those conversations, a lot of times you'd be amazed to hear, I want to be retired and I'm thinking this thing's going to be sold, right? And you only hear from the CEO, you never hear from the employee.
Right.
So if they're contemplating being acquired, I would think that, and again, I don't know, I'm not a valuation guy, but I always thought it was like a 3-year look back, right? They're going to look at 3 years of financials. If you rip the Band-Aid off in year 1 and you think you're going to sell in year 2, it might be a bad idea. If you rip the Band-Aid off in year 1 and you got 3 years left, then it's a great idea, right? Because now financials are all looking better across the board. So do you ever get in conversations like that, or is that beyond the scope of the conversation?
No, living the life I do, I spend a lot of time with folks contemplating restructurings versus raising capital versus selling the bank, right? Those are all different uses of a strategy, of a capital use, of et cetera. And so I think your mathematically, you're accurate with your statement. If I knew I was probably going to sell in a year, I wouldn't take the loss and restructure, because the buyer is going to buy my own balance sheet and they have to mark all the assets and liabilities to current market anyways. That's something that's attractive to a buyer if they can get the deal done. And so interest rates will play a role in the M&A front. And people will tell you that, last couple of years, M&A was a lot slower. And that really had to do with where interest rates were and where bank stocks prices were. Now, post-election, we saw a nice bump in bank stocks. So naturally, everybody feels a little bit better, up 20%. And now stock prices sound better, look better. That typically leads to more M&A. And so that's the anticipation and the run up in bank stocks. And also less regulatory pressures, given whether that's perception or reality, it doesn't matter. We know the markets trade on perception more than anything. So you're seeing that as part of the bump as well.
Okay, so more currency out in the market. Hey, currency.
That's exactly right. That's right. That's exactly right, Charlie.
Okay, all right. So
you can afford more.
Right. Okay, so actually, as I think about that question that I just asked you, if you leave those losses on the books, it will affect the price you receive as a seller.
There you go.
Right.
So that's why, quite frankly, at the end of the day, if I sell an asset today and I buy another asset today, I'm basically kissing my sister for the most part, unless I've taken some undue crazy interest rate risk, credit risk, optionality risk. But if I've stayed pretty consistent, then I've really not done too much. That's why I'd argue for doing it a lot of times, because if it's zero sum, six, one half dozen the other, then if I can restructure it for another component to get my balance sheet more predictable, and so that in 2 years, if I'm looking to sell and I've got a very consistent earning stream, regardless of movement in rates because of the restructuring I did, I think I would probably get a better price, right? It's worth a little bit more.
Yeah, I got you. Okay. So then maybe last question in the stream, I wanted to ask about when you said that some of these folks are pulling them off the books. Is it all of them? Like all might be a pretty painful statement to make if you want to go, or are they doing them over a 3-year period so that you can look at the financials and kind of say,
right,
we took a one time, we expect to take a one time next year.
We'll be right back.
Is your technology spend getting a little out of hand? Are you worried about making those big strategic moves because of those hefty vendor contracts? Or maybe you just feel like your technology is currently holding you back. In today's banking world, overspending on technology is a risk you just can't take. Going up against those major vendors on your own can be tough, expensive, and especially when the contracts are designed to benefit them. That's where Remedy can come in. Remedy Consulting helps our clients stay competitive and grow their business with the right technology, products, and their spending strategies. Not a Remedy client yet? Head on over to remedyconsult.net for a free review of your tech stack, spending, and contract terms. Even if you're not the perfect fit, you'll walk away with expert advice and confidence in your technology decisions. Check us out at remedyconsult.net or give us a call at 262-955-7776. Thanks for tuning in, and now let's get back to the episode.
Yeah.
Right.
I'm in the camp of, and now we've got governors, right? Now one of the governors is your regulatory capital. So right now, your marks on those bonds, while I told you they were held in your GAAP capital so everyone can see them, you know where they're not? They're not in your regulatory capital. So if I take a $10 million loss, that $10 million reduces my regulatory capital to a level that helps us back into how many assets I can sell. It's all math. It's all math. That's exactly right. So we give ourselves a buffer. We look at, we run, and I say my team does. I'd love to tell you I'm smart, but I'm not. They do all the hard work. But what we'll do is we'll look at all the math behind all the pricing of all the assets, and we can say, look, we can get out of all of these assets, remain really well capitalized. We've lowered your risk-adjusted assets by buying all agency-backed securities. We've improved the cash flow stream of the bank going forward. Now we can evaluate taking a loss or not. So they're really governors working for you. So you can only do so much. But I would argue that the better bang for your buck is to probably do it once in larger form than bleed it every quarter.
I got you. Because the investors understand it, and your board will understand it if you're not publicly held. They get it. They just don't want to keep getting it, I suppose, probably.
Probably right. And you know what? You had a hurricane in your house. You don't just fix a quarter of the roof, right? You fix the roof, you move on. It costs a lot. It stinks. You move forward. You got a new house, roof, and everything's good. That's the way I always kind of evaluate it.
I got you. Okay, good. No, that's I wasn't thinking about the regulatory capital. That's a good point. Never even. So, okay. We were talking about an inverse curve. Inverted curve. Sorry. Inverted.
Yes, it's okay.
So the inverted curve, is that better or worse? Like, did the guy get fatter or skinnier, or you know what I mean? Right? What does that look like given those moves you were talking about from October to today, et cetera?
Yep. So two things. When people throughout the country think about our yield curve, right? They think of the shape of the yield curve, and you want to think about yield curve. You usually look at the 2-year part of the yield curve and the 10-year part of the yield curve. People like to call it the 2s and 10. Where I really focus for banks is I like to call it the bank curve. And my bank curve is the spread between Fed funds and about the 5-year area of the yield curve. Okay. We typically fund ourselves somewhere around the short end of the yield curve. We typically lend on the commercial real estates, somewhere in that 5-year area. And that kind of makes our yield curve. What's really interesting is in 2023 and 2024, that curve, to your point, was inverted at historic levels. And when you've got the short end higher than the longer part, or the belly of the curve where you're lending out, you're paying more for money to come in than basically you're earning when you're lending it back out.
So you're saying sort of the Fed funds rate versus the 5-year?
I like to look at that spread. That's right.
Okay. So when you say it's inverted, Fed fund rate is higher than what you're lending out at.
That's right. Or where the
just
benchmark rate is.
Yeah. And so that was 2022, 2023, did you say?
2023 and 24.
23 and
20, yeah, yep, that's right. It was historically positively sloped, ironically, in March of 22, just as we were starting to get into the Fed hikes, right?
Yeah.
What was interesting is 2s and 10s had no yield curve. It was flat as a board.
Really?
But the Fed funds in 5 had almost 200 basis points positively sloped. You know what happened to bank margins in 22? Had one of the best years we've seen in a long time. However, in 23, every bank underperformed their budget. 24, very similar because we had the inversion of that curve. It's expensive to get money in, and you're not earning enough on the money out.
Yes. The Fed moves have an approach on that, or an effect on that?
They did. So what was interesting is the minute the 50, remember everyone was debating, is it going to be 25 or 50, the first one? And it ended up being 50. The 5 minutes after it was 50, the belly of the curve went down like a stone in the water. It sunk fast. Okay. However, by the end of the day, and the next day when Powell had kind of come out to kind of give a little context to his comments, what I took away from his comments were, you know what? I know everyone's going to overreact with 50 and think that the world's ending. It's not. We probably should have done 125 in July and one here in September. Everybody calmed down. You know what happened? Yields went higher again on the belly of the curve. And since that moment, since October 3rd or whatever that is, all we've done is seen basically rates higher over that 6-week period. Okay. So even before the election, now some of that had to do with people betting on election. So pre-election, right, yields and rates were starting as we got closer and closer to the election date. Interest rates were betting that Donald Trump was going to win, and that higher interest rates were going to happen with growth. You could see that starting to play out. Now that Donald Trump won, and I don't know if you want me to go to post-election now.
Let's hit. Yeah, because my next question was sort of Fed versus the election. What the effects are on this thing.
Yeah,
let's go to election. Yeah, absolutely.
Yeah, I think so. Now you've got a couple of things. Regardless of which side of the party which side you voted, you're just thrilled that the election's over and we have an answer, right? No, everyone is, right? That's one. I think everybody in the country can agree on one thing: no more commercials for a little while. So we're excited about that. So now you take a step back and you think about there are certain industries like financials that have taken off in the stock market because of, you said this earlier, less regulation is expected from the Republican side of the world versus the Democrat side of the world. Now that we have clarity on that, that's a really important point on the bank stocks. So you move past that, interest rates went higher after the election because there's probably it's a pro-growth view of the country. And so you had that combination happening. And so you're seeing a little bit steeper of a yield curve so far, which is great. And I call yield curve, again, Fed funds in 5. Mm-hmm. We've had another 25 basis point rate cuts. We've had 75 basis points total now. And you're seeing that 5-year area hang on, if not go higher as well. So that's starting to get closer and closer to a steeper curve. So what banks are preparing for today, and I'm at our Piper Sandler equity conference today, talking to a lot of different banks, what we're all preparing for is what happens to our earnings when we have a positively sloped curve? What does it look like? What's the impact? And what are the opportunities and exposures I have to that? And when I identify my exposures, that's when we start getting into hedging and repositioning and asset liability management at its core, the things that I love to do. So people are starting to prepare for those as you think about where we are today.
Gotcha. So does the House and the Senate both being Republican now, which I think I heard they just sort of solidified that it would be, any effect on this or not really? I mean, is it really just kind of the policies of the president?
No.
And I always think of it like this. I think, okay, whether you're Republican or Democrat, if you had both the president, the House and the Senate, you could get a lot more done, right? One way or another, your policies are going to go through for the next couple of years. Any effect there, or is it all kind of the same as we already talked about?
The way I would say it, Charlie, is it was kind of priced in. It's been priced in. That's basically what the market now, with elections in and polls and numbers moving around. I know we didn't have all the answers, but we had a lot of them. So the market kind of already moved towards the Republican control. And I think you're right. When you've got everybody on the same quote unquote page, more of the agenda should get accomplished, like tariffs and other stuff that you may see. And so again, this is not a political statement. Now I think I can tell you, being downstairs at this conference, there's a little bit of an upbeat feeling, Charlie, over the last couple of years. People feel like a little bit less regulation and a little bit more growth is probably a positive for a lot of our folks. And so I think just the clarity that we now know. It was the unknown that markets hate anyways.
Yeah.
So bank stocks have been out of favor for so darn long, worried about interest rates, worried about credit, worried about liquidity. So finally, while we're still concerned a little bit about credit and some other components, the index bumped up, and now generalists who don't spend every day, all day buying bank stocks are saying, maybe I should buy into the bank stock world. So that's what's feeding the frenzy a little bit too.
Excellent. Well, Scott, it's been awesome.
Yeah.
And I think we've covered some good territory here, right? I mean, obviously there's a lot more to cover in this space. And as you know, I love having you on here because we always have a dynamic conversation.
Well, listen, next time we get on, we'll kind of review where I'm wrong, right? We'll have a little even more clarity, and you can remind me. People love to remind me when I'm wrong. It's all fair, but we're still getting information. We're still getting clarity. I'm still meeting with a lot of banks to hear what's going on. So I'll have updates for you. You can always reach out, and I always enjoy catching up with you, Charlie. I appreciate what you're doing for the bank space too.
Excellent. All right, Scott. Thanks for taking the time for us.
You got it. Always. Take care.
Okay, just wanted to say thanks again for Scott taking the time. He's obviously a busy man, but to me, I always find it fascinating because there's so much moving in that world, and particularly with the election, we want to make sure that we had the opportunity to kind of cover what's going on in that space. So that's it for Bank Talk today. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast, brought to you by Remedy Consulting. If you'd like to reach out to Scott, you can find him at psc.com. psc.com will lead you to the Piper Sandler website. If you like what you hear, please rate, review, and share our work with others. Thanks again, and we'll see you in the next year and next episode.